Good afternoon. Thanks for joining me for Hard Money Happy Hour. I've been on a little hiatus, little vacation, little summer break. We're back now. Some Nooners, vodka soda, black cherry. I like the high noon. I'm not a huge black cherry guy. Anyway, I wanted to catch up on some happenings in real estate, happenings at Trius Lending Partners, happenings in the real estate investment industry over the last few weeks since we've been gone, and just broader, speaking of like sort of macro view of what's going on in real estate, a little bit about the economy, et cetera. It's going to be sort of a multi-part Hard Money Happy Hour because I have a few things I want to say. One of the big things we're hearing over and over again is what's going on in the market? Good, bad, what should I do? How should I react? I would say that's probably what we're spending here at Trius Lending Partners most of our time dealing with, is talking with people, in a way, acting as therapists to a lot of real estate investors, some of the newer ones, even some of the older ones, some who lived through the collapse in '08, some who didn't live through that, some who've only known things going in a certain direction. Our message is the same and is consistent. Slow and steady wins the race. This is not anything that can be timed. You hear a similar type of expression and similar terms used with stock market investing. Not a financial advisor, I don't want to be giving that advice, but I can tell you that a lot of the same language that financial advisors and stock gurus use: stay with the market, stay for the long term, don't try to time when you get in and out. I can speak as a real estate expert and say it's the exact same thing. You've got to be in it for the long term. You've got to take a long-term view in it and still be active and an active participant to find that long-term success. And that's what we're explaining to people. I lived through 2008 personally. I was in mortgage and finance at the time. It was shocking, it was difficult, it was challenging. But we talked to people who bought places, properties, real estate investment properties at the height of the market in '06, '07, right before the collapse. And we've talked to them about how that investment has worked out. And they explained how it dropped 30, 40, maybe even 50% in the '08 collapse. But then we keep talking with them and sort of peeling back the layers of the onion and their story and understanding that as they held that property through '08 into 2010, all the way now to 2022, they've been collecting rent on it. The property has gone back up to where they bought it and now exceeded the price they bought it at. Their mortgage has been paid down, so they're getting cash flow. Mortgage balance is dropping, so they're picking up equity there. Value overall is increasing, so they're picking up equity there. So they're looking right now and saying, as of 2022 now, I feel pretty good about that investment. I went through a lot of rocky roads and a lot of ups and downs to get there, but it paid off in the end. Those are the kinds of stories and messages we're conveying to a lot of our real estate investors.